Once again, thank you so much for joining us for the webinar hosted by the Council on Foundations, Self-Dealing Concerns for Private and Corporate Foundations. I will now turn it over to our faculty, Staff Counsel for the Council on Foundations, Ben McDearmon and Remy Barnwell.
Thanks, Caroline, for getting us started. And good morning, good afternoon, everyone, depending on where you are. We're going to get started with a discussion of the statute that kind of governs this realm when it comes to self-dealing. So Section 4941 in the Internal Revenue Code gives us a good overview of what happens when it comes to self-dealing, what the taxes are that are imposed. So generally, we get all of our guidance from 4941, and although it says private foundations, it's important to note that corporate foundations, most of them, are organized as private foundations. So this is also applicable to corporate foundations. And the statute, as a baseline, imposes a 10% penalty tax on the disqualified person or the self-dealing individual for any transaction between a private foundation and a disqualified person if that transaction was made knowingly. And then 4941A2 imposes a further 5% tax on any foundation manager that knowingly participates in an act of self-dealing for each act. And that 5% is 5% of the amount involved in the transaction. So just some takeaways from 4941A1 and 4941A2. It's intended to prohibit certain transactions between private foundations and disqualified persons. We will discuss in a slide in a minute who is a disqualified person and how you can determine that. It also prohibits financial transactions with third parties that might provide a more than incidental benefit to a disqualified person. So if there's an individual that's a substantial contributor to their foundation, to your foundation, and that individual owns a manufacturing company, then that manufacturing company would be the third party that you're prohibited from engaging in financial transactions with. As I mentioned before, it's also applicable to corporate foundations because most of those are organized as private foundations, and the penalty taxes are imposed on both the foundation itself and a foundation manager if the distribution is made knowingly by that foundation manager. A good question to ask yourself when you're determining whether a transaction is an act of self-dealing is whether the distribution will benefit the corporation or a disqualified person in a way that's more than incidental. So the definition of self-dealing we can find in section 4941D of the Internal Revenue Code. And this is just a general definition. Generally, it's the sale, exchange, or leasing of property between the foundation and a disqualified person, lending money, goods, fulfilling some sort of financial obligation or pledge on behalf of a disqualified person, advertising for disqualified persons, or providing any sort of preferential treatment or recruitment or even business opportunities to a disqualified person or an organization that they're over. So who is a disqualified person? Foundation managers, that's kind of the most obvious place to start. And that's going to include officers, directors, trustees, employees, anyone who has the authority to act on behalf of the foundation. Substantial contributors to the foundation. So that includes the foundation's parent company. It can include any individual who gives a giant donation, family members of any of those parties that I've mentioned. So the spouses, children, grandchildren of any foundation employees or substantial contributors to the foundation, certain government officials, and then the bottom disqualified persons, those are really focused on businesses or entities. So a corporation in which 35% of the voting power is owned by disqualified persons, a partnership in which 35% of the profits interest is owned by disqualified persons, or a trust or estate in which 35% of the beneficial interests are owned by disqualified persons. So those are entities that are disqualified based on their relationship to disqualified persons and how much power disqualified persons hold in any of those entities. Common issues for self-dealing, hiring disqualified persons, that's something that we will discuss. That's generally considered an act of self-dealing. There is an exception for personal services, which Ben will discuss at some length shortly, but that is generally an issue. A good example for that is if you had an individual who was a substantial contributor to your foundation, and that individual owned a company that manufactured candles, and your foundation contracts with that candle manufacturer to produce 1,000 candles for your office space or whatever, that would be an example of self-dealing, and that would be prohibited. Like I mentioned, there is an exception that Ben will go over. Another common issue is travel expenses. So if your foundation were to pay for the plane tickets for your CEO and her family to go to the Florida Keys on vacation, that would be a pretty obvious example of self-dealing. Attending fundraisers, that's one that we got several questions about, and I'll let Ben discuss in more depth that issue, because there are instances where individuals from the foundation can attend fundraisers without issue, but generally that's something that we suggest you steer clear of, because it's important that the attendance to the fundraiser doesn't provide any disqualified person a more than incidental benefit, which is something that we'll cover shortly. Paying pledges, legally binding pledges, that's a pretty clear act of self-dealing. And then sharing resources is also something to be wary of. But each of these examples has a corresponding exception that we'll discuss. So the self-dealing rules generally, this is an overview. The self-dealer has to correct the violation. So if there was a transaction of $100,000, that was an act of self-dealing, then the disqualified person would have to pay that back. There's the 10% penalty imposed on the self-dealer, which I mentioned comes from 4941A1. And then there's a 5% penalty imposed on managers, foundation managers, who knowingly engage in any act of self-dealing, and that comes from Internal Revenue Code section 4941A2. So I will pass it over to Ben to go through some of those exceptions of the common issues that we just went over.
Thanks very much, Remy. So now that we have talked about the basic framework and have an understanding of where the prohibition, the general prohibition on self-dealing and what that means in a broad sense, where that comes from, we're going to look at some of these exceptions and some potential pitfalls that frequently arise in the context of self-dealing or situations that could appear to give rise to self-dealing. So it's worth noting here, as we discussed in the previous section, generally speaking, almost any transaction with or between a private foundation and a disqualified person is going to be self-dealing unless it falls under a specific exception. And so some of the ones that we frequently encounter: paying compensation for personal services that are reasonably necessary in carrying out that foundation's exempt purposes, assuming that compensation is not excessive. Those have long been accepted and are referenced in the Treasury regulations. to make it clear that private foundations can pay individuals or entities that are considered to be disqualified persons for those services that carry out those reasonable and necessary purposes of the foundation. Now, it's important to think about that in terms of, is it necessary in order to accomplish these purposes? And is that something that is reasonable in light of the activities being carried out? So what is reasonable and necessary at one organization may not be exactly the same as what's reasonable and necessary at another. It's a very fact-specific situation. Compensation, of course, then may also not be excessive. So it's not enough to say, well, this was for a purpose that was reasonable and necessary in carrying out the foundation's exempt purposes, if it is found that the compensation itself is excessive in light of what the actual responsibilities are. So it's very important when setting compensation that there is an independent review of market data that shows this is what the going rate is for these types of services, and that you have exercised appropriate due diligence to make it clear that you understand what a market rate level of compensation is. And in the case of compensating directors or other disqualified persons for services within the foundation as employees, it's especially important to have an independent committee look at those figures and make that determination without input from the disqualified person themselves who is being compensated. So it can be done, but again, you need to approach this with caution just to make sure that you are ensuring that these amounts being paid to individuals who are disqualified persons is not deemed to be excessive. The Council on Foundations annually puts out a grantmaker salary and benefits study that helps. It's one of several resources, but I think a primary one that a lot of private foundations rely on in helping to set what is reasonable compensation, what is not excessive for specific roles. And that's broken down, of course, by types of roles, size of the foundation, geographic area, all sorts of factors that can play into what is and what isn't excessive compensation for a particular role at a particular foundation. Another exception, this comes into play in a lot of different capacities, but incidental and tenuous benefits. So that's another one referenced in the Treasury regulations under 4941 that you see come up in a number of these situations. I'll get into some more details here. One of the most common ones that we encounter this with is public recognition for disqualified persons, name recognition. So it is understood that if a grant or other activity paid for by a private foundation results in no more than simply name recognition to a disqualified person, whether that's the company in the case of a corporate foundation or a member of a family, of the family that established the foundation or serves on the board, that can be okay as long as it's just name recognition alone. There are no other benefits that arise as a result of that activity or payment, because the IRS has said that name recognition by itself doesn't have a more than incidental value. It's incidental and tenuous to the larger public purpose that's fulfilled by a grant. Consumer goodwill for a corporate entity, that's another one where, and again, we're going to get into specific situations for corporate foundations a little later, but it's worth understanding that if the sole benefit to the company is that employee or customers rather, or prospective customers simply have a good association with the name of that company because of some activities that it has funded, that by itself is not going to be an act of self-dealing. Similarly, increased morale for company employees. So if you're funding activity and employees generally feel good about working for a company because they like that they're working for a company that gives back to the community, or they are asked to participate as volunteers in a nonprofit that's funded by the corporate foundation, and the only benefit to the company is this opportunity for employees to volunteer, that by itself is not going to result in an act of self-dealing either. We're really just talking about these sort of tenuous benefits of, goodwill, morale, anything that doesn't have a real monetary value, but we generally understand to be favorable in the aggregate. Providing goods and services to disqualified persons, including potentially a company and company employees on the same terms as the general public. So that's another area where if you are providing services or goods through a foundation and there are disqualified persons or potentially employees of a company who may benefit from that. As long as it's the same terms available to the general public, it's part of a general program. You can see this, for example, in the context of scholarship programs. And some of you may know, corporate foundations can run scholarship programs to benefit just employees or their dependents. That's another area where, if we're following the proper steps to ensure this is not actually disguised compensation, if we're making sure that this is not really just a way to reward people for working at the company or to otherwise get them to follow a specific course of action sought by the employer, that it is in fact for the benefit of these individuals as part of a legitimate charitable program. And so it will not be an act of self-dealing in that sense. All right, so looking more directly at these personal services exceptions, when we talk about personal services, it's important to know there's not a definitive, exhaustive list of what is considered to be a personal service. It is fairly narrowly interpreted, though. So a list here of some things that we know for certain because the IRS or the tax code has told us, or in the regs, these are included: banking, legal, accounting, investment management. There's a reference in the Treasury regulations to somebody serving as a broker for a foundation, but specifically not as somebody who acts as a principal in their own right and buys and sells property by the foundation. So they do make a distinction there. So generally what we understand this to mean is if it's not specifically listed in a ruling or in the regs somewhere, we shouldn't really assume that a service that could be carried out by a disqualified person will meet this personal services exception. Some of the things we know for sure from some rulings that have come out over the years that have been decided that they are not personal services: interior decoration, IT work, janitorial or administrative. And by administrative, we mean, I think, more clerical type work. A lot of consulting type arrangements have been deemed over the years in one form or another to not be eligible for this personal services exemption. So when we are using this as a justification for providing compensation to disqualified persons, it is recommended that we stick pretty closely to those things that are specifically enumerated in one way or another and have received the blessing of Treasury and the IRS. We're talking about, again, reasonable, what do similar people get paid for similar work, and then necessary, consistent with the foundation's charitable purposes. You essentially could not carry out the operations of the foundation for one or more of its exempt purposes without somebody filling this role, without somebody actually doing this particular work that the compensation is being paid for. So it's okay to pay compensation for reasonable and necessary services as long as it's not excessive. This is just another checklist here to kind of go down there. Limited personal services has to be reasonable and necessary, and you need to make that determination that it is not excessive compensation. And then on note here, I did see there was a question in the chat about excess tax related compensation of private foundation directors. I see Remy responded that we're going to get to that at the end. So yeah, just wanted to address that since I did see that earlier and we were talking about compensation at the moment, but we'll have some time to get to that at the end. So travel expenses here, moving into other types of potential pitfalls or possibly exceptions, depending on how we are structuring it here. So in general, we understand from what Remy told us that the spouses and children of disqualified persons are also themselves considered disqualified persons. So paying travel expenses for them to go, for example, to attend a retreat put on by that foundation, to have them accompany the disqualified person, paying their expenses is going to be self-dealing, except in some limited situations where the family member actually has a reasonable duty to carry out for the foundation while attending that meeting. And they also need to treat that reimbursement as if it were taxable income to the person whose relative is being reimbursed. So it needs to be reported as income, and they do have to have a reasonable reason for being there to justify having their expenses paid for. And a note, of course, at the bottom there that the expenses have to be reasonable. We aren't paying first class tickets and buying rooms at the most expensive hotel in town when we are paying for disqualified person to travel for foundation business, it needs to be a reasonable level of travel and accommodation, considering that we are dealing with, of course, tax exempt dollars that are to benefit the general public welfare and are not to inure to benefits for private individuals. So always keep that in mind. If you have private foundation disqualified persons who travel on foundation business, it's recommended that you have a travel expense or reimbursement policy in effect, that you have pretty clear guidelines on what types of travel expenses and accommodations are going to be covered and what kinds will not be covered. All right, attending fundraisers. This is one that we get questions kind of a lot. The reason is, of course, you've got, and I think both the corporate foundation context and private family or independent foundations, you have situations where there is perhaps a fundraising event and the foundation wants to be a sponsor, and frequently these sponsorships come with some other benefit like tickets to the event or a table, and people want to know, is there a way that we can use these as a foundation for staff or board members potentially to attend. And so it's important to note that it's frequently going to be a self-dealing issue. If there is a ticket that's used by a disqualified person, they almost always have some sort of economic value. I haven't really seen many cases, with the exception of in the last couple of years, I had people ask me whether attendance at a virtual event during the pandemic, sort of a virtual fundraising thank you event, where there was no actual food provided or anything other than just getting a Zoom link and kind of like we are now, sitting around at your own computer at home. That probably doesn't have an economic value in its own right. But most of these events where you're going in person, there's dinner provided, or especially the ones where you have access to a table and perhaps can invite other people to attend and sit at that table. Those are going to have some measurable economic value. And so it's probably going to be self-dealing. There are some situations where it's okay. And it's really, there needs to be a duty by the person attending on behalf of the foundation to monitor and evaluate. So there has to be some justification for that person attending on foundation business. So if it's a grantee who has an event and you have a foundation representative there who is, making, essentially it's a work trip. They are going to monitor and evaluate how this grant has been used, or that possibly the grantee is presenting the outcome of a specific project, and you're having somebody there to see how your grant funds were spent. I would still say document, have that person take some notes to make sure it's clear they were actually attending for a legitimate foundation purpose, report back to the board to make it clear there was a reason they were there. It wasn't just a social event. But outside of that context where there is somebody who is a disqualified person using those tickets or having a table at an event, it's likely going to be an act of self-dealing. So we need to usually just decline any of those tangible benefits that arise from private foundation grants when attending a fundraising event or making a grant to sponsor an event that comes with these sorts of benefits. A note at the bottom that bifurcation is not allowed. Bifurcation, for those of you who aren't familiar with that practice, is where the private foundation pays the deductible portion of a sponsorship grant, and a disqualified person who's going to use those benefits would pay the non-deductible portion. So if, for example, a $10,000 sponsorship where an individual contributor might be able to claim a $9,000 tax deduction, and they valued the value of the tickets or the table at $1,000, a private foundation could not make a $9,000 grant and have a disqualified person pay the remaining $1,000 to attend, because it's deemed to be an act of self-dealing, because that $9,000 paid by the private foundation essentially allows that person to simply pay $1,000 out of pocket to attend. Otherwise, as an individual, they would have to pay the entire $10,000. They could claim a tax deduction for the $9,000, but they wouldn't be able to just pay $1,000 to attend in that situation. So the IRS said about 30 years ago that is an act of self-dealing. Bifurcation is not allowed from a private foundation. And paying pledges is another situation that can occasionally get people into trouble. Here we see, assuming the debt of a disqualified person is self-dealing. So we understand that that's actually true if you were, for example, to transfer property subject to a mortgage or other lien that existed before the transfer, and expected the private foundation to assume that the obligations under that mortgage, that would be self-dealing. Similarly, any assumption of debt that a disqualified person is legally obligated to pay is going to be an act of self-dealing. So legally binding pledges, that's the key here. If it's legally binding on the individual who made that pledge, or another disqualified person, if it's a company, could be a pledge made by a company. If that's legally binding, it may not be paid by the foundation. And it's important to note that from one state to another, the definition of exactly what creates a legally binding pledge can vary. It is a matter of state law. Frequently, in many states at least, there is the general principle that if an organization to whom a pledge has been made relies on that to their detriment, so detrimental reliance is the legal concept there. If they say, well, we understand that you were going to give us $2 million to build this building, we've relied on that, we've had plans drawn up, we are taking steps to break ground on this construction, you may not be able to back out of it and say, well, I've reconsidered, I didn't actually mean to commit to this. In a lot of states, that will be sufficient to say a pledge is legally binding at that point, because they have relied on the fact that you've made that promise to pay. But again, it's worth checking in your state whenever there's a pledge situation, to get somebody who's qualified in your state to give you an opinion as to whether a specific communication with a prospective grantee or other nonprofit that may be construed as a pledge actually rises to the level of being legally binding. And if it does appear to be legally binding, a private foundation should not be paying for that, because it would be an act of self-dealing. Sharing resources is one. This arises frequently in the context of company foundations. However, it could also come up. Family foundations, I know, will sometimes share some resources with maybe a family-owned business that's not a direct funder of that foundation, but maybe there are, sharing office space or some staff even. So generally speaking, when we're talking about sharing resources, it's worth noting that if it's done at no charge to the foundation, it's almost always going to be okay. So foundations can receive, they can use office space that is owned by a disqualified person, as long as they aren't paying rent or other operational costs associated with that. It is okay if there are shared services, such as janitorial services or other building related maintenance services, where they pay a portion of those services that's attributable to the private foundation and the space they use, but they need to pay it to the company that's providing those services, not to the disqualified person, landlord, as it were. So a note here too, that disqualified persons can usually donate other resources as well. You can't take a deduction for partial interest in property, so you don't get to claim a tax deduction for letting a private foundation use your building that you own rent-free. You also can't generally claim a deduction for donated services. You can make a 0% loan to a foundation. That's kind of one of the only exceptions to being able to provide some exchange of money between a disqualified person and a private foundation. A zero interest loan would not be an act of self-dealing if provided to a private foundation. Whenever you're dealing with shared resources, it's really important to keep very detailed records, as far as particularly in the case of employees. If you have employees who are paid for by a disqualified person, such as a corporate parent with a corporate foundation, you want to make sure it's clear what time they're spending working on the foundation, what time they're spending working on the company. If they're being paid by the private foundation at all, it's especially important. These people are keeping incredibly detailed records of their time. They're essentially, in that sense, they're working two jobs for two different employers, and you want to make sure that no time that they're spent being paid by the private foundation is actually spent on work that's being done for the benefit of the company. So it's a best practice to simply donate their time if they meet for these personal services. It's likely okay, as long as you're very careful about how you structure that and how you keep records of how these people are spending their time. Okay, and then we're going to move into corporate foundation concerns. As I promised, a specific section here just to deal with some issues that arise most frequently in the context of corporate foundations. So sponsorships, I mentioned a little bit earlier, public recognition. All these things listed here are permissible if that's all that's resulting from a sponsorship grant. Identifying that company by their name or using their logo or slogan or their trade name, anything that just identifies the company that isn't qualitative or comparative. We'll talk about advertising and incentives to buy in a moment. But if it doesn't rise to the level of advertising, then it's likely okay. You can list where the company is located. You can provide its contact information, a link to its main website, no specific product pages or anything else that could be viewed as an inducement to buy a product or service, but a link to general information about the company, where it has offices. All that would be considered to just be name recognition or public awareness, and none of that by itself is going to be more than an incidental or tenuous benefit. Advertising, on the other hand, so this is where we're kind of crossing that line beyond what is permissible, beyond these tenuous and incidental name recognition opportunities. Company product price information or any other indications of savings or value. So if the slogan is more than just a non-qualitative, non-comparative, but really talks about why this product or service is better than the competitors, or anything that contains specific information about a product and how much it costs. Well, as I said, links to specific pages on a company's website that contain products or services and include ways to purchase those. Those are all going to be examples of things that could be construed as advertising, and therefore would be acts of self-dealing on the part of the private foundation. So need to avoid that. Endorsements. This one can be tricky. If you have a grantee who's speaking at an event and they are thanking you for your sponsorship, you just want to make sure they're clear. When this grant came from a private foundation, you can thank the company, thank the foundation, recognize them by name, but please don't talk about how great their products or services are, or anything that kind of goes more into that, more of an endorsement of a specific company and promotion of business. Any inducement to buy or sell or use a company's service, facility, or product. All of these things, if it results from an opportunity that arises out of a private foundation grant, it needs to be very carefully structured to avoid the appearance that you're actually receiving advertising, whether that's at a live event or whether that's in a booklet or brochure or on materials that are sent out as part of that, recognizing sponsors. So some examples here. I mentioned this grantee speaker endorsing a company during an event, product lines, items and prices that might be showcased. So if you have a sponsor table, you won't have any information about pricing or products at that. Product giveaways, unless the company is there and is also in its own capacity giving stuff away as a sponsor. If it's just the private foundation involved, we don't want to be crossing that line to promoting company products. A link to product pages on a grantee's website, as I mentioned. Anything more than just a link to that company's main website is likely too much and should be avoided. And then this idea of rewarding or seeking customers, it's okay for corporate foundations to focus their giving within geographic areas where the company is located, or where either customers or maybe even potential customers may be located. So that by itself is not self-dealing. We have to be careful, though, that we're not targeting specifically customers or somehow using private foundation grants to incentivize people to become customers. So that's where we sometimes get questions around, well, can we have a program that targets only customers of our company? And of course, that would likely be self-dealing, because having a program that is essentially seen as a benefit to being a customer of this company provides a more than incidental benefit to the parent company. But generally speaking, if you have a presence in these areas, but you're not going out of your way to specifically target customers or attract new customers because of foundation grants, that by itself is not going to be self-dealing. Similarly, supporting organizations that they may have customers or potential customers as clients of theirs. So if they're nonprofits and they serve people who are your customers or may be customers of yours, that by itself is not a problem either. You're not giving preference to customers by the terms of these grants. It's simply understood that if you're providing grants in an area that you have a presence, it's likely that depending on the type of business you are, that some of your customers may very well avail themselves of services provided by these nonprofits. And if that's done without regard for their status as a customer of the company, that should not result in any problem. And then the same thing comes with positioning the name or the logo in connection with sponsorships and grants. So again, getting back to this idea of name recognition by itself, we're talking about increasing the general goodwill felt towards a specific company. I understand it can sometimes be tough to really accept why is this okay, given that I think most of us know that people pay good money to have their names out there, to have their names associated with positive aspects. But just know that this is the longstanding position the Treasury and the IRS has taken with respect to name recognition by disqualified persons. And it's time and time again reaffirmed that this is considered to be merely incidental and tenuous, and that by itself, it doesn't have a significant enough value to constitute an act of self-dealing. And then finally, a note about the types of activities you can support that may have some impact on either the company's activities or bottom line, as long as, again, we're looking at, is it incidental and tenuous? So corporate foundations can support scientific research in areas that benefit potentially that business's interest. Now, they can't be narrowly limited to something that would only or primarily support just that business, just that company. But if it's research in an area that is of general benefit to that particular company's line of business, the idea is it's likely just as beneficial to any of that company's competitors. And so in that situation, it's not going to be seen as more than incidental and tenuous, because the larger public benefit and any benefit that arises to companies is really going to be shared equally among that company, the disqualified person, and any potential competitors too. Same goes with economic development in communities where customers are located or potential customers may be found. This kind of gets to that same point we made before, where if you're enhancing the quality of life or economic conditions in specific areas, we're understanding that the primary benefit is to benefit the public, to benefit those communities. The fact that there are some people who may actually be customers of your company or may become customers of your company, as long as it's not targeted to them, it shouldn't be an issue. And again, what we really want to focus on is to, if it was economic development activities that primarily benefited a very specific, more narrow part of land that most of the land in that area was owned by the company, clearly there we're getting into the situation that may be more than incidental and tenuous. But if it's a larger geographic area, community where the company has a presence, where it may have some customers, but it isn't targeting those people and it's not narrowly tailored to benefit specifically the company, we're not likely going to run into a self-dealing issue. And then finally here, a note on conflicts of interest and how these compare with self-dealing. So it's one way to think about this is that self-dealing is sort of a smaller subset of the larger concept of conflicts of interest. Self-dealing will almost always be a conflict just by nature of those relationships, but not all conflicts involve self-dealing. So if there's not a disqualified person involved, then it's not going to be self-dealing, or if it falls under an exception, it's not going to be self-dealing under the definition provided within 4941, but it could still be a conflict. Conflicts are more broadly applicable, so not just to private foundations, but of course public charities, even direct corporate giving for those corporate foundations on the webinar today. Know that conflicts of interest can exist in situations where you don't even have a foundation involved at all. So these are things that much more broad also can be overcome. And so we'll see on the next slide here that it is possible to overcome. So the definition of what this is, it's really, we're talking about a situation where a person is in a position to derive a personal benefit from their actions or decisions. And there's some competing interest between them as a personal interest and their professional interests or their obligations to that organization. So frequently we're talking about situations where somebody is on either the board of multiple organizations, potentially private foundation and a grantee, or they may be a board member, but also employed by a firm that foundation is looking to use for some services. These are all examples of things that are conflicts, may be self-dealing, but they might not be. If they aren't self-dealing, the existence of a conflict by itself doesn't mean you can't carry out an activity. It just means you need to effectively manage it. Every foundation should have a comprehensive policy that defines what are conflicts, who's covered by it, and how it should be handled. Typically, this is you disclose it, and then that interested person has to recuse themselves from any deliberation or voting. Frequently, they are allowed to answer limited questions of a factual nature to help the rest of the individuals who are deliberating make a decision, but they can't attempt to sway the decision by any of those other people. So it's again about managing the conflict. If it's not truly self-dealing, it doesn't mean it's the end of the road. It just means you need to be careful about how you handle this to avoid the appearance that the person who had a conflict exerted any undue influence on that decision. As a note, it often overlaps with the self-dealing rules, especially in the corporate foundation context too, but it could be in really any private foundation setting. The foundation hiring a firm owned by a board member or where a board member works, as I mentioned. Again, you can do it. First of all, we need to make sure, are we actually benefiting somebody who is a disqualified person? Is it self-dealing? So if it's a firm where somebody works and you're able to make it clear that this person isn't actually receiving any additional compensation, isn't otherwise financially benefiting from this relationship, then it can be done. That person would need to still recuse themselves. It's a conflict, but it probably isn't self-dealing. If it's a company that's primarily owned more than 35% by a disqualified person, then you're looking at that entity itself is a disqualified person. Then we're looking at, does it fit any of these exceptions for self-dealing, such as the personal services exception? Is it one of those services that's listed under the personal services? Can we structure it in a way that it is deemed to be necessary and reasonable and also not excessive? Then it may be possible to do it. Again, that person still needs to recuse themselves from any decision making on that. Similarly, a foundation paying for services provided by the company itself in a corporate foundation context, that's always going to involve a conflict. There will frequently be numerous people who are on the board of both the company foundation and the company itself. So we need to be careful around how those decisions are made. Approving grants to charitable organizations with shared board members, relatively common, shouldn't really be a self-dealing issue as long as those individuals are volunteer board members. That's really the test, is, are they volunteer board members? If they're not receiving any compensation, or assuming, what sometimes comes up is there's a relative who is a staff member and a grantee. That's another common one. We want to make sure that the grant isn't in any way used to pay compensation to those persons. So you could make a specific project grant as long as it's clear that that's not going to be used to compensate the disqualified person at all. So it can be done. Again, we want to make sure that the person who's conflicted is recusing themselves from that decision making, and then direct giving to organizations that are favored by key employees of the company or favored by any individuals who are on the board of an organization. You can, of course, make grant decisions based on any number of factors, but you want to make it clear that we're not giving to somehow benefit, or at least have the implication of there being some sort of favorable treatment for any of these individuals who are in a position to make decisions related to grants. So we have reached the end of the presentation. I know we have some more questions in the chat here. And we have some that we've received in advance too that we wanted to make sure we got to while we're on the call here. So let me go through the ones that we make sure we've gotten in advance, just to make sure we get these, and then I'll take a look at the Q&A that have been submitted. So there was one question about, there are two cases where self-dealing was not an issue, wondering why these differ, and then there were links given to these two. One is from 1973, Revenue Ruling 73-407, and the other is Revenue Ruling 80-310. These are, and I touched on these a little bit during the presentation, but to kind of clarify, these are the Revenue Ruling 8310. This is one describing a scholarship program at a university where a corporate foundation and the company that created it are located. And the scholarship program was to pay for scholarships for students who are studying a specific field that is of interest to the company. And so this ruling said this by itself is not self-dealing. It's an incidental and tenuous benefit. In theory, the company benefits from having more graduates in this area who are trained in this field and could potentially employ those. However, that same could be said for any employer who has a similar line of work in that area. There's nothing a part of that scholarship program that requires people to go work for the company after they graduate. It was, I think, named after them, but it doesn't have any other connection or requirement. So really kind of goodwill. They generally benefit to the same extent as any other employer from the fruits of this public benefit, which is largely to enhance the local education in this particular manufacturing process. And so that's the justification for a lot of activities where you're funding an activity through a private foundation that may, to some extent, benefit either the company or a disqualified person in the non-corporate context. But the benefit itself, because it is fairly remote and it's not narrowly targeting, the grant isn't specifically to benefit the company, we're looking at, is it incidental and tenuous? So this is a good one to look at to kind of help us understand where the guideposts are for something that's incidental and tenuous in nature as far as a benefit from a grant program funded by a private foundation. And then Revenue Ruling 7407 is one that gets to the question of name recognition. And this is one where a private foundation made a grant to a public charity on the condition that the public charity agreed to change its name for 100 years to the name of a substantial contributor to that private foundation. So that person's a disqualified person by virtue of there being a substantial contributor. And the IRS said, this isn't self-dealing because it's just name recognition. Even though essentially it's a 100-year agreement to name this public charity after this disqualified person as a condition of making this grant from the private foundation, it doesn't result in any more than incidental benefit because mere name recognition alone, under the way that they have defined this over the years, does not give rise to anything that's of more than incidental value, and it's merely tenuous to the larger public benefit served by making this grant to a nonprofit that is carrying out other good work for the community. So I know that answer doesn't really help people who struggle with this concept of, well, why is name recognition not considered to have a more than incidental value? I get it. It doesn't always seem logical, but that is what the IRS and Treasury's position has long been. So getting to these other questions here, let me see, going back in time here. I see there were some that had been answered already. I think we can safely ignore or no, some of these were, let me go back to these. Okay, yeah, this first one, any updates on the excise tax related to compensation of private foundation directors? I think this is probably referring to, if I'm interpreting properly, Section 4960, which is an excise tax on employees of related organizations or tax exempt organizations that are greater than $1 million. So that's essentially excess compensation is what they call it under the code. It's a tax of 21% on any excess paid by that organization or a related organization to a covered employee. There was some debate when this section first came out a few years ago as to whether does that implicate somebody who is a board member of a private foundation, but they are also a well-compensated individual who's employed by the company that established it. And they're not paid by the tax exempt organization, but they are paid potentially more than $1 million by the company that funded it. Does this give rise to it? It's something that the council sought clarification on a few years ago. And our position at the time was that under the definition as it's described, that if it's truly just a volunteer capacity that they are serving and they don't receive any compensation from the foundation itself, that the person probably isn't a covered employee for the purpose of the tax. I know there were some updates in 2021. It's getting hard to track all the years now. There were some final regs that addressed some questions around this additional tax. I'd be happy to share some of those, but nothing recently. So there hasn't been any recent movement on this, at least since I believe this was early 2021. So we're coming up on closing in on 2 years since any changes to that. Let's see, what else do we have on this section? Make sure we don't have any others that we haven't gotten to. Remy did a great job covering a lot of these. So going back to these open ones, question, all right, if you are dropping a press release about a new grant from a corporate foundation, can you include boilerplate company info along with boilerplate foundation info in that press release? I think so, as long as we're talking about boilerplate information being truly just descriptive, not qualitative, nothing that would look like advertising. We get to the question sometimes of, is it okay for, what if only the company received recognition for a grant made by the private foundation? And there, it likely doesn't give rise to self-dealing. It's still, I think, probably a good idea to make sure if you're going to credit the company, you also credit the foundation, just to avoid any confusion as to who the actual grantor is. But it probably, under the guidance and generally the guidance around name recognition, simply having information about the company that doesn't rise to the advertising or promotion of business by itself isn't going to be a problem. And then another question here on, can a foundation and a corporation split the cost of something? Does that cost split need to remain consistent year over year? There, it really depends. I mean, the idea is that yes, generally you can. I mentioned in the sharing resources example, if you have office space that the company donates to the foundation, and you have other services that you pay for, utilities, janitorial or other maintenance services that are not provided by the company. So if it's somebody else and you're sharing your own proportion of those costs among the foundation and the company relative to the space they occupy, as long as they're both paying for their proportionate share and they're paying the provider directly, then that wouldn't be self-dealing. But we want to be careful. We're not reimbursing the company for some portion. It is going to be self-dealing. So we want to be careful that we're structuring that in a way that satisfies that definition of, or that exception rather. Another question here to confirm, self-dealing is specific to private foundations. That's right. So if a corporation uses a donor advised fund or a corporate advised fund instead of a private foundation, there's no self-dealing potential, but certainly potential of conflict of interest to be very aware of. That's generally right. So the self-dealing rules that we're talking about here only apply to private foundations. They don't apply directly to DAFs. However, there are special rules that do apply to donor advised funds that somewhat mirror the private foundation rules. So you still have some potential issues to be aware of as far as benefits back to the company or any other disqualified persons. The company is essentially considered to be the donor for the purposes of this donor advised fund. And so they are a disqualified person under a different set of rules that are applicable to public charities and DAFs. So they are still prohibited from receiving any more than incidental benefit under section 4967. So there aren't actually any guidelines to date or Treasury regulations to help us understand what is considered a more than incidental benefit from a DAF grant. Therefore, most practitioners actually kind of look to the private foundation rules as a guide. So that's really all we have. We're hoping to get more regulations from Treasury regarding donor advised funds and prohibited benefits. At some point, there have been some intermediate rulings and some provisional rulings or notices that have come out over the years, but no formal regulations have been promulgated yet. There's also a prohibition on any exchanges between donor advised fund and any disqualified persons under section 4958, the excess benefit transaction rules applicable to public charities. Normally, those rules say disqualified persons of public charities can engage in transactions, but only if they're fair. So it's not a general prohibition like with private foundations. It looks at, is this a fair transaction with respect to what is the public charity receiving in return? In the context of donor advised funds, though, there's a specific, more harsh rule that says any transaction whatsoever, regardless of the amount, regardless of whether it's fair or not, is actually going to be an excess benefit transaction. So in practice, it kind of functions the same way. So we want to make sure no direct transactions between DAFs and the company. And certainly you have to watch out for any more than incidental benefits. But the self-dealing rules, strictly speaking, they're not directly applicable to these situations. And then employee assistance funds are also, are employee assistance funds also admissible for corporate foundations to support? Yes, depending on how we're structuring that. So if you're giving money directly to employees from a corporate foundation, or I would even say if you're contributing to an employee assistance fund held at a public charity, administered by a public charity, but that's coming from a private foundation, you want to stick to just those disaster situations that are covered under Section 139, so qualified disasters. Really, if you were making a grant from a private foundation directly to employees to provide assistance after a disaster, anything outside of the context of those Section 139 disasters, which for those who don't know, we mean presidentially declared disasters, things that arise from military or terrorist activity, disasters involving common carriers, so like a train or airline crash, things like that. So big presidentially declared events, the COVID-19 pandemic, big hurricanes that hit periodically, things like that. So those are situations where private foundations can make direct assistance payments to individuals without it being an act of self-dealing. That's also, I would say, the safe approach if you were funding an employee assistance fund held by a public charity, but the money is coming from a private foundation. It's not, I've never seen anything definitive that says that's absolutely the only thing that you can do. I just think that's, if you're reading the rules closely, a best practice, because it looks like, if you couldn't do it directly using a public charity to pass those funds through and then make payments to individuals that you wouldn't be able to make from the private foundation directly, to me looks like just trying to skirt the rules by using a public charity. You could, of course, make contributions directly from a company to a fund held by a public charity, and you could use those for any number of different disasters that maybe don't meet the definition of a qualified disaster under 139. But for private foundation funds, I think we need to strictly limit those to 139. All right, any update on the ACE Act related to changes to private foundations? Is Congress considering adoption this year? No, to my knowledge, there is really no movement on ACE. There are obviously a lot of other things that are seen as bigger priorities than that. So I have not heard anything lately that gives me reason to believe that there's going to be any movement there. I will say one area that is included in the ACE Act that has seen the light of day in one other area is under the Biden administration's 2023 fiscal year budget, their proposed budget, sometimes called the Treasury Green Book, that was released earlier this year. One of the proposals that was in that mirrors that treatment of private foundation contributions to DAFs under ACE, where we would be, if you're treating it as a qualifying distribution at the private foundation level, you would then have to make a distribution out of that DAF within the same year or within the following year in order to count that. So that is actually another area where that single provision under the ACE Act has made an appearance, albeit this time in the executive branch. So no idea whether that actually has any traction being implemented this year, but just to be aware of, that would essentially enact, if that were to come to pass, that would be one provision of ACE that has found life in another avenue, limiting, not saying you can't use a DAF from a private foundation, just limiting the instances where you can count it as a qualifying distribution, making sure that that money is then granted out again within a year. Okay, another question here. It seems that in some areas of the country, it is nearly impossible to stay under the per diem rate of the IRS. Example, New York City. That's probably true, and especially lately. I don't know, for those of you who traveled recently, I went recently, and it's like, yeah, it's crazy everywhere. So not even New York City, even places you might not think were very expensive. Can a disqualified person stay there, or do they need to go to Brooklyn to afford a hotel? Good question. Yeah, I mean, really here we're looking at reasonable. I mean, if you're If your policy says we're going to follow this per diem and we're not going to pay more than that, you really, I think, first of all, you need to follow your foundation's policy, but I think you have some flexibility there. If you're looking at within the reasonable distance of where you're trying to go, we're not saying people have to commute an extra hour once they're at their destination just to get to their meeting, but certainly looking at what are the comparable rates for accommodations in the area where you're staying. Are you staying in, certainly not the upper echelon of accommodations, but if you're staying at a, going rate for a specific area, those things fluctuate a lot depending on the time of year that you're traveling and how much notice you have in advance. So you should have some flexibility there. You just want to document that, you did stay, you did make an attempt to stay in a reasonably priced accommodation relative to where you were. Can a foundation and a corporation split a nonprofit sponsorship fee? This gets to that question of bifurcating grants. So it really depends. Is the purpose to use that for to attend an event, have people potentially attend using tickets that are received as part of that? This would be an issue because if somebody's using tickets or sitting at a table that's paid for in part by foundation grants, that's going to be a bifurcated grant. It will be an act of self-dealing. So if the purpose is to have some benefits that are actually being used by disqualified persons, then you really need to look at, well, if we're going to have disqualified persons use it, if we want company employees or board members to be able to attend, we need to just pay this out of the company. If the purpose is merely to just split the cost, but we don't have any benefits accruing to it, then there's certainly no reason you couldn't do that. Is it self-dealing if a foundation grant recipient uses the funds to purchase goods or services from the corporation? As long as it's not a requirement of the grant, I have seen that sometimes that question comes up. You don't need to prohibit them from purchasing them. Certainly, I would say the grant agreement should be silent as to any reference to the company and its products. But if they are using it for a program and they need to buy, say you have a computer manufacturing company and they need to buy computers as part of their operations, there's certainly no reason they couldn't if you're the best provider for that and they choose to go with you. So as long as there's no appearance that it's actually structured to require them or to induce them to buy products of the company, it shouldn't be absolutely prohibited. And then finally, does work by employees of a corporate company need to be counted as 100% donated services to their private foundation? I think if I'm understanding what you mean by this question, are we saying we're donating the entirety of that? And actually, let me go back to this one and see what was meant by counted as 100% donated services to their private foundation. I hope I'm answering this correctly. If you want to email me with any clarification, feel free to do so. I think our contact information is also on the slides here. But yes, if I'm reading this correctly, we need to, if they are not being paid by the foundation, it does need to be reported. The entirety of the time that they spend working would be considered donated to that private foundation. So feel free to send me an email if you want to provide more details if I'm misreading that, but that's my best interpretation of your question. Okay, I think we have made it through all of the questions that we've received so far. So yeah, see our contact information here. legal@cof.org is the best way to reach us. And we're happy to talk, any other questions that come up, or if you want us to look at some specific situations that you didn't want to get into on this webinar, we're happy to do so. So feel free to shoot us an email.
Thank you everyone for joining. Goodbye.
Thanks, y'all.
Thanks, everyone.